there, I hope that you're doing well. Welcome to the first lecture of the day trading model. This lecture is going to be about order flow. Before we begin this lecture, I want to share a few key notes with regards to this series. The first note is the following. During this series, I will guide you to a higher level of understanding price delivery. This does not mean that you will reach profitability after watching this series straight away. The reason why I can't promise you to become profitable is the following. You are an individual who has its own struggles. You might be given rules, but for some reason you are not disciplined enough to stick to those rules. You will bring a lot of mental struggles to this trading. And that's what makes it so hard. And we will have psychological lectures as well. So I will share with you insights how to overcome the majority of certain psychological struggles because I've been through them as well. Anyone that says that this can be easy, that it's easy to understand how these markets work and it's easy to make financial decisions based on them, is absolutely lying and you should run away when someone says that. Secondly, it's important to note that from the release of this lecture, every single week a new lecture will be finished until announced that the series is complete. And from there on, future add-ons will be added, but not every single week. And finally, I want to share with you the following. It's important to take proper notes from day one. So that means during this lecture, if you hear me say something that you believe to be valuable, you should write it down and then come back at a later point in time and restudy it. Because the greatest light bulb moments don't necessarily come whilst watching or studying new educational content. As weird as it may seem, the greatest light bulb moments that one can experience actually occur just while doing regular daily stuff. Maybe whilst going for a walk and you're thinking about that new concept that you've learned, and out of nowhere it clicks. Ah, that's why it works. And that's what I hope that you will achieve after watching this first lecture and the lectures that will come. Because that light bulb moment is the most beautiful thing that you can experience. And every single light bulb moment should be journaled and cherished. So, enough of the rant, let's begin with the Orderflow lecture. Before we begin, I must give you a risk disclaimer. I am not a financial advisor and I will not give you any financial advice during this series. All I will share with you is my understanding of price delivery and my view on the markets. This is meant for educational and or entertainment purposes only. If you want to read the full risk disclaimer and the terms of services that you have agreed upon when joining the mentorship, you can do so by going to our website, theonesthatknow.com, and then scroll through these files. This model is ideal for the personality that is interested in getting in and out of the market within a relatively short period of time due to a variety of reasons. The reasons that could be present for a person to be interested in day trading over swing trading can be the following. He or she does not want to be attached to the charts all day. And you might think, huh? Are Isn't it true that swing traders aren't only not attached to the charts all day? No. Reason why is because the model that will be shared with you is very time specific. So that means there are intervals during which we will look at the charts. We will not look at the charts outside of those intervals. And you might wonder, why would we do that? Because during very specific time intervals, the market delivers in a certain manner. So if we know that, our job is to show up during the right times. Because it's time that comes first and then price. It's not, okay, the price pattern is present and it doesn't really matter what time it is. It's London lunch, it's 5 a.m. in the morning, but you know what? I see a bearish breaker, so therefore I can trade it. No. You will be given very specific times to look for very specific algorithmic signatures within the delivery of price. And that's the goal of this model. And finally, this model is ideal for the personality that has a short attention span, meaning that he or she has not the ability to focus for long periods of time and therefore has to be very objective about during what times he or she will utilize their focus. So it means during what hours they will really focus and be present and only think about the charts. Before you watch this lecture, it's important that you have watched the foundation lecture, which has been uploaded on the 15th of December 2023 on the mentorship platform, and that you watch the beginning of the IPDAT journey, which was uploaded on the 30th of December 2023. The reason why I want you to watch these lectures before beginning this model series is the following. I will not treat you like a complete beginner. I will be talking to someone who has already built up some understanding of how to look at price delivery from an algorithmic perspective. And the reason why I want to do that is because I do not want to make it too uncomfortable for the more experienced traders to look at these lectures. And I know that you might think, for as a complete beginner, why aren't you then sharing it again, the knowledge? Well, because the knowledge has already been shared within these lectures. And just so you know, what I'm referring to is just a simple understanding of imbalances, a simple understanding of breakers, a simple understanding of just in general PD arrays, just sell side liquidity, buy side liquidity. I would not share that again within this series because I believe that you should already know this before you watch this series. So let's now really dive into this lecture. Before we can determine order flow, we need to know by what order flow gets measured. We will not be using any depth of market, volume profile, or whatever tool retail-minded traders might use that they believe to give them insights on the markets. All we will use is a blank chart. And on that blank chart, we will only use time and price. Meaning, at very specific times, we will be looking at very specific algorithmic signatures that will show us whether or not these algorithms are right now active within the markets. First of all, you might think, Susie, you just said we're not going to discuss any basic knowledge, and now you're showing us an uptrend. I know, but I'm going somewhere. Just wait. Here we can see an uptrend. An uptrend is basically that higher highs are being made. What we call this is bullish institutional order flow. Means that the market is going higher, retracing, higher, retracing, higher, retracing, higher, retracing, higher, etc. That's bullish institutional order flow. For bullish institutional order flow to occur, there has to be a market maker buy model. A market maker buy model is simply the following schematic. It means that there's a sell side delivery, aka delivery lower into a very specific price level, our point of interest. And from there on, buy side delivery occurs. So the market delivers higher and we see that uptrend occur. It's very important to note that this all has to occur during a TOI, aka a time of interest. If we anticipate higher prices, we will look for the POI to be reached during our time of interest and wait for signatures to confirm the SMR. The reason why this is important to know, because if we want to gauge order flow, we first must know, okay, what are potential key reversal prices where the market could tap into before reversing. And if we know that there's a certain price level that is significant, for example, a higher time frame PD array, and the market trades into that, then we can wait and see, okay, will any reversal signs be present? If not, okay, then the market is going to continue the original order flow. If it does, however, show signs of reversing, then order flow is switching and a change in the state of delivery is occurring. If we take a look at a downtrend, it's the following. Lower lows are being made and lower highs. So if we take a look at this, we see sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery. All right, so here we can see the market maker sell model schematic very simply put. So what we can see is that there's repricing higher into our point of interest, into that very specific price level, during our time of interest. And if we anticipate lower prices, so if our narrative and higher time frame order flow is signaling to us, okay, well, we're likely to deliver lower for the upcoming period, then we look for that POI to be reached during our time of interest, and then we wait for signatures to confirm the SMR, aka the smart money reversal. And notice that we're not even looking at the different stages of the market maker models just yet. The market goes higher until the point of interest gets reached during our time of interest. Then we see signatures that confirm a reversal occurring, and from there on we see sell side delivery or lower repricing. Alright, so now we're going to take a look at reversal patterns. There are two possible reversal scenarios. The first one is a breaker block formation, and the second one is a mitigation block formation. There are no market reversals unless one of these two occurs. You can go into the charts after you know what they look like, and you will never be able to see a reversal occur without one of these two occurring. It's as simple as that. So let's take a look at the breaker block formation. As you can see, the breaker block formation is the following. We can see that sell side delivery occurs, the market reprices lower, a low gets engineered, the market retraces, creates a high, and that high gets utilized to send price lower once more, purging sell side liquidity, trading into our point of interest, into this price level, and from there on a reversal occurs, market displaces to the upside, and from there on we anticipate this upclose candle to be utilized as support moving forward. You might wonder, why would this occur? Why would we want to see that upclose candle act as support on price? It has to do with balanced price ranges. Balanced price ranges are the following. They are, in my opinion, the most important thing to understand when it comes to understanding the hierarchy of institutional order flow. A balanced price range can be understood when you look at delivery cycles from a seesaw perspective. So that means you start counting how many times each delivery cycle has occurred within a very specific price range. So if we start counting, you can see the following. We can see that sell side delivery occurs here. Inside of that sell side delivery, a CB gets created. The market offers buy side into that CB, and it then offers sell side again, trading away. Into what? Into the sell side liquidity engineered below this low. So it purchases that liquidity by tapping into our point of interest, and it then reverses to the upside. But hey, what occurs here? Buy side delivery gets delivered again. So from there on, if we start counting again, we can see sell side, buy side, sell side, buy side, but there's something missing. Why is there something missing? Because this buy side delivery higher has made the delivery within this price range, within this CB, imbalanced. So what has to occur is the following. The market has to reprice lower over sell side delivery before it is allowed to expand higher. And that's why you will always see a retracement form into a breaker block, and specifically into the imbalanced price range here before it continues to the upside. And it's the same for mitigation blocks. However, one important thing to note is that buy side and sell side delivery doesn't always necessarily mean that it has to first trade away a lot. So it means that candles have to be formed outside of that price range and that it then retraces. That's a possible scenario. However, another possible scenario is the following, in which there's a wick of a candle that reprices above the high of the breaker block. I apologize for not having the box annotated perfectly to the high, but I wanted to show it clearly that this is the high I'm referring to. So the moment that a wick reprices above that high, it's already a confirmed change in state of delivery. And what's possible is that the next candle then completely shoots price higher after opening inside of that breaker block. Why is that allowed to occur? Because if that open occurs and sell side delivery occurs once more in the form of a wick, the market has already delivered efficiently inside of that price range and it's allowed to expand to the upside. So therefore, a breaker block it's part of a balanced price range, and your breaker blocks form inside of imbalanced price ranges. So if we take a look at the mitigation block looks like the following. A mitigation block is when sell side delivery occurs and the sell side delivery trades all the way into our point of interest, into the price level where we're anticipating a reversal to originate from. From there on, a high gets engineered. That high then sends price lower once more, but it does not create a lower low relative to this low, to the low that formed prior to the high. And then price expands to the upside. The up close candle is the mitigation block, and we can apply the same logic to see whether or not this is a balanced price range now when the market has retraced into it and expanded to the upside. We can see the creation of this CB here. Then the market retraces into that CB, into that bearish fair value gap. It forms a high, so it means buy side delivery has occurred, into a price range where only sell side delivery occurred. Then sell side delivery occurs out of it, buy side delivery occurs again. So you might think, oh, but now we have 2 times sell side delivery, 2 times buy side delivery, right? Yeah, but buy side delivery by itself already here has an imbalance inside of it. There's a BC that formed. So that means sell side has to be delivered again before the market is allowed to expand higher. So that is why we can look at this and say, okay, well, a mitigation block is basically a failure swing. There's a failure for the market to create a lower low after the creation of this high. Whilst for the breaker block, a lower low gets created, and that's why we call that a full swing. And one of the important things to note is that when a breaker block forms on one market, we usually see the formation of a mitigation block on a highly correlated market. And that means that one creates a lower low, whilst the other creates a higher low. And that's what we call SMT, Smart Money Tool, or Smart Money Technique. There's not a real name dubbed to it, but what SMT basically signals is that smart money is actively buying this market inside of a bullish scenario. For the bearish thesis, for the bearish breakers, just invert the logic, and the same for the bearish mitigation blocks. So for the bearish mitigation blocks, you would be looking at a high that would form, a low that would form, then a lower high would form relative to that initial high that formed, market displaces to the downside, then that last low is your mitigation block. And for the breaker, it's when a high forms, a low, a higher high forms, displacement below that low. Now that low that formed initially, which sent price higher, is your bearish breaker. So it's just the logic shared here, but then inverted. Alright, so here we are in the real charts. And I'm going to explain to you what I mean with a higher time frame retracement is the left side of the curve, and that the expansion leg on this higher time frame is the right side of the curve within a fractal market maker model. What we can see is the following. We can see that there's an indecisive candle that forms after we have seen multiple candles to the upside, right here. What then occurs is that a high gets created here, and the market then displaces lower or gets repriced lower into the high of this up-close candle here. This is what we call immediate rebalance. I'm going to take you with me to the lower time frames to see how price reacted off that immediate rebalance price level. But after that immediate rebalance occurs, we can see that the next candle immediately targets the buy side engineered above this high. So here we can see the lower time frames. And as you can see, this dotted line is the high of that previous higher time frame candle, aka the immediate rebalance that occurs. What we see is that buy side got engineered above these highs here. This is our original consolidation. Then the sell side of the curve unfolded here into that price level. After that price level was reached, the market then reversed, targeting buy side liquidity. If we go into even a lower time frame, we can see the following. We can see our market maker buy model in here. We can see that there's an original consolidation up here. Then we can see the distribution phases in which every retracement is being sold by smart money. And from there on, we can see that more buy side liquidity gets engineered here. Look at the equal highs that get generated. And the market keeps on displacing lower. Expand, retrace, expand, retrace, expand, retrace, expand, retrace, expand, retrace. Until it reaches that very specific price level at 1:22 p.m. And from there on, we can see that the market begins to deliver to the upside. Targeting what? Targeting the high of that candle, of that indecisive candle. And if we take a look at this reversal here, we can see our bullish breaker formation. Where do we see the bullish breaker formation? We see the bullish breaker formation inside of this up-close candle here. And the reason why this up-close candle is important is because this up-close candle formed, or this high formed, after we saw an initial leg lower, a low get engineered, boom, market retraces. It retraces into what? Into this CB here. From there on, it gets utilized to send price lower once more into our key price level. Boom, some time distortion here. Don't get fooled by that. Begins to displace to the upside or expand to the upside. Imbalance forms inside the breaker. Retrace, boom, sends it higher, targeting the buy side liquidity above that high. If we take a look deeper into this chart and we zoom in on the smart money reversal, we can see the following. We can see that I've extended this CB all the way to the right. And you might wonder, why is this high not important to you? Why not this high? Why specifically that high? It's because what I just outlined to you. When a high gets formed inside of an imbalance, the moment that that high gets broken and the moment that that imbalance gets broken or displaced above, if this was a CB, what we then want to see is that we want to see the price range of the CB and that up-close candle get utilized as support going forward, because a change in the state of delivery has been confirmed by then. It already gets confirmed earlier, but if this occurs, it's so sweet. And you will see it so many times in your charts. And I have dubbed this pattern in which there's a CB that gets formed, a high that gets formed in that CB, followed by a displacement leg above that high as the market structure shift pattern. But there's one more thing you need to note, as the following. Within the break of this high and this CB, within the price range that breaks through that high, there has to be an imbalance. There has to be a BC. This doesn't necessarily mean that the BC has to be created above this high, but it just means that in the sequence of candles that breaks through that high, there should be an imbalance that we can utilize to buy from going forward. And that's what we call the market structure shift pattern. So here's the final delivery where again the buy side liquidity above here got showcased. So let's take a look at another chart. As you can see, here we are on another chart. For those of you that are wondering what chart this is the door index chart and then the monthly chart. What we see is the following. We can see that the market consolidated here. It purged sell side liquidity below these lows, then reverted higher, or it retraced into this CB here. This is a CB because there's a lack of buy side delivery inside of the price range between this low right here to this high. The market retraces and it then begins to fall over, begins to expand to the downside. What I want you to understand is that by looking at this chart, we can see the following. We can see that buy side delivery occurs here or a retracement, but within a lower time frame, we will be able to see that that buy side delivery is the left side of the curve within a market maker sell model. This expansion leg lower from that CB is what we call the right side of the curve, or the sell side of the curve within a market maker sell model. And what we see is that if we zoom in onto the weekly chart, we can see that this was the buy side delivery. Boom, market consolidated a bit and it then fell over. What we see is that inside of that sell side delivery, there are multiple retracements that occur. So you have an expansion leg lower, retrace, expansion leg lower, retrace, expansion leg lower. And the reason why I'm sharing this with you is the following. If we think back to what was shared with you and we understand that a retracement on this time frame is the left side of the curve within a lower time frame or fractal market maker sell model, we already know that if we would zoom in deep enough or low enough on the time frames, note this is a weekly chart, we will see sell models all over the place. So if we know that the order flow on the highest possible time frames has shifted bearishly or has been bearish, then what we can see is that if we go into lower time frames, we can see that from those higher time frame price levels, smart money reversals occur, breaker block and mitigation block formations occur, and from there on, reversals occur that gets utilized before price is allowed to expand higher or lower in this case. If we zoom in on that reversal point above here, we can see the following. We can see that a high gets created here, low, higher high. The moment that this low gets broken, it's already a sign of, oh, it's a change in the state of delivery, potentially. Why? Because this low formed inside of this CB. But what do we know then? We see that consolidation takes place. Why? Because it was not the right time yet for the market to reverse. So what then occurs is that within this down close candle, which is a bearish breaker here, there's another bearish breaker that forms inside that consolidation. Because what we see is that a high gets engineered here, a low, and that low gets utilized to then send price higher, taking out the buy side liquidity above here. What then occurs is that displacement occurs below that low, below that down close candle, Market has to retrace. Why? Because smart money bought this down close candle and they need to mitigate their losses. So the market gets offered higher, retrace, boom, gets utilized to send price lower. And what I want you to understand again is that within this retracement leg higher, there's a fractal market maker sell model that formed. Buy side of the curve into a price level where we can anticipate a smart money reversal to occur from, followed by the sell side of the curve. The same occurs here, where we see a low form here, two equal lows, market retraces into the CB, institutional order flow entry drill takes place, boom, price gets sent lower, taking out the sell side liquidity below here. And what I want you to understand is that within a lower time frame, a market maker sell model is present here again. Buy side of the curve, sell side of the curve. It happens in every single market stage. All you need to do is go into low enough time frames and you will see the market maker sell models occur. Simple as that. So let's now take a look at time frame synchronization. Before we can use time frame synchronization to determine the drawing liquidity, we need to first know how to spot institutional order flow. It is crucial that you understand this because without an understanding of institutional order flow and or narrative, you will get caught up in chasing price patterns for the sake of chasing price patterns. It will make you just a new retail-minded trader. It will just make you a bull flag or whatever animal pattern you might use trader. That doesn't matter. It doesn't matter that the pattern occurs. What matters is that the pattern occurs at a very specific point of interest at the right point in time during a time of interest. That's what matters. So how do we determine order flow and narrative, really? First of all, we can look at the news and the general market sentiment. We know that when markets are going higher and when the news is becoming very bullish, euphoric, so to say, we should be cautious because we know that news gets utilized, or that leg higher gets utilized for smart money to open short positions against, to sell against. So when the news turns bullish and price is near or at premium race being premium breakers, premium mitigation blocks, premium inefficiencies, premium balanced price ranges, premium volume imbalance, etc., premium liquidity pools, we should be warned because we know that they use that news for manipulation purposes. When the news turns bearish and price is near or at discount arrays, we should also be warned. Discount arrays coming in the form of, for example, discount balanced price ranges, discount breakers, discount mitigation blocks, discount imbalances, BCs to be precise. And we know that they utilize that news for manipulation purposes again. So when the markets are dropping, we want to be looking for signs to justify looking for buy signals if the higher time frame order flow is bullish. So let's take a look at the same schematic again, but let's now add another variable to the sequence. The variable that we've now added is the following: news. As we can see, during the sell side of the curve, news gets released. This news gets utilized to send price lower into our point of interest during our time of interest. This news gets utilized for the final repricing lower before the real move is allowed to occur. And that's something that a lot of people seem to not get. Many people that have been trading and they have been investing, they have been active in the stock market, etc. we also ask them the question, what usually happens when positive news comes out? What follows? Well, usually they say the price begins to start dropping. So what happens when bad news comes out? Well, usually the price begins to start rising after a period of time. So that means that initially there can be, if the news is bearish, a leg lower. But that leg lower follows that higher time frame order flow into that price level that we've been waiting for. And from there on, a buy program unfolds, sending price higher. And it's funny to realize that because then it makes sense how the whole smart money paradigm sets you free from all retail minded traders, their beliefs, because they look after the fact why something has happened. We look on the right side of the charts, that blank area that no one has ever seen or touched. That's our goal as smart money minded traders. If we take a look at the market maker sell model schematic that I've been utilizing with you so far, we can see that there's a leg higher, and near the end of that leg, near the reaching of a point of interest, news gets released during a time of interest that sends price higher into that price level that we've been anticipating and waiting for. And from there on, a sell program begins and price is distributed lower. So again, the function of the news was to send price higher. Once more, trap retail-minded buyers into believing that the markets were going to continue to rise. Boom, lower time frame, break or mitigation block formation during the right time, and there it goes. Smart money reversal confirmed. And here's an example of that. As we can see, this is an article of Reuters, however you pronounce it. And what we can see that on the September 20th, 2023, they wrote an article saying the dollar index on the verge of forming a bullish golden cross. The Bank of America says. So the Bank of America is a pretty substantial bank within America, and they said that the dollar index was likely to form a very bullish retail-minded pattern, so to say. If we take a look at the dollar chart in a bit and see when this news article was released relative to where dollar was at, and we look at it from the perspective that I'm teaching you to look at the markets from, a light bulb moment should go off. At September 20th, that article came out from Reuters. It was inside of this candle here on this day that article came out. Notice that afterwards there were only about 10 candles that were still inside of an uptrend. And from there on, a monthly CB gets reached, that CB that we discussed. And from there on, the sell side of the curve unfolds. And what I'm trying to prove to you here is the following. The moment that, so to say, legitimate sources or reliable sources or governments come out and they say something that is against our higher time frame idea of what should occur, it's the best confirmation tool that we can utilize because we know that they manipulate these markets and they utilize the news for repricing purposes. So therefore, I suggest you to just go into your own charts and see when certain things were said and what was followed. Because if we think about what occurred in 2020 when the C virus came out, I'm not going to say it out loud because then this mentorship platform might be shadow banned or something like that. I'm not too worried, to be fair, because it's our own platform, etc. We're not depending on any sources, but still I'm being careful with saying that because we know how it goes on the internet nowadays. Because that sea virus came out, we saw the markets drop for a few months. There was panic. People were like, huh, what's happening? And blah, 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 all of that stuff. However, what followed was one of the most explosive boom markets or higher repricing events that occurred in the past decades. So, what we can take away from that again is that the news gets utilized for repricing purposes, and therefore we can anticipate news as well to come by simply looking at the charts. What happens is already priced in, and the news comes after the fact. And I'll let you think about what that really means about how controlled and engineered this world really is. Secondly, to spot institutional order flow, we will be looking at the relationship of the PD arrays that get created and act as support or resistance, or fail to do so. Within bullish order flow, our eye is drawn to a blue shaded box here on the left side of the curve, on the sell side of the curve. Inside of that blue shaded box are inefficiencies, CBs to be precise. The market reprices into our point of interest, into our price level during our time of interest. Boom, market expands to the upside. And because these CBs are failing to act as resistance on price, meaning the market doesn't retrace into that CB and then continues lower, because it fails to occur because those CBs fail to act as resistance on price, it's a sign to us that a change in the state of delivery is occurring or has occurred. Because if we take a look at, or if we think back to the example that was shared prior with you with regards to the market make a buy model on NASDAQ, and we think back to that CB that got created, then a high formed inside of that CB, market was sent lower. After reaching our point of interest, the market traded above that CB, and now that CB began to act as support on price moving forward. The reason why that's important to note is because if the market would be bearish, that CB would not get broken, it would not get violated. So if it does get broken, as we can see occur, then we can say, okay, now buy side is likely to be the draw next. But only if our point of interest has been reached during a time of interest and we see the confirmation signs that we will be looking for. And here's another example. What we can see is that there's a CB on the left side of the curve that got created here. A high formed inside of that CB. This is that same price example again, by the way, but annotate it a bit differently. What we see is that that high gets created inside of that CB. Price gets sent lower afterwards, purging the low that was utilized to even create the high in the first place. Then the market reverts, and from there on, a buy program begins. But what confirms the buy program? Well, if we take a look at this price action and we see this CB, this is the most significant CB inside of the final leg lower to my eye because this high formed inside of it. So the moment that price breaks above that high, I want to see the candle of that high be utilized as support moving forward. And the fact that price broke above this CB signals to me, okay, there's a willingness for the market to now move higher. And if we take a look at all of the CBs that followed afterwards, or I mean the CBs that got broken afterwards, you can see a CB here. Fails to act as resistance on price. Price breaks through it, boom, begins to act as support on price. Next CB, up here, price breaks through it. Here, boom, CB begins to act as support on price. Next CB, here, price spends a bit of time in it, but eventually breaks through it. And then that CB begins to act as support on price. So what I'm showcasing to you is that we need to look at the left side of the curve in order to determine how the right side of the curve is likely to deliver. I will go more on depth in this later because we will specifically look at the left side of the curve to also justify entries and trade management. However, for now it's important to note that the moment that the imbalances on the left side of the curve begin to fail to act as resistance on price, we need to be warned and we need to anticipate higher prices to occur next. So if we are taking a look at bearish order flow or the market maker sell model, our eye is drawn to BCs that form inside of that final leg higher, targeting or price level or point of interest. The moment that those imbalances get broken, get violated, we will be looking for a change in the state of delivery to have occurred, and therefore sell side delivery is likely to be next. Because if the market was going to continue higher, it would retrace into those BCs and then continue higher. Here we are again on the dollar chart, and what I've done is that I've annotated all the BCs and extended them to the right. All the BCs that are significant to my eye and that are easily spotted by you. What we can see is that the highest BC here got broken through, and notice that all the bodies closed inside that price range. There were a few wicks above it, but the wicks do the damage and the bodies tell the story. What we then see is that this BC is also relevant. Why this BC specifically is because we can see that a real significant low formed inside of that. Same can be said about this BC here. Next BC is here. And notice how price is first finding support in or at those BCs. Retrace, boom, gets broken. This BC again, market trades into it but completely overshoots it. Market trades into a lower BC as well. This is where short-term low gets created. Market retraces. Look at the bodies closing below 50% of that inverted fair value gap. Boom, sends lower. And the reason why I'm showcasing this to you is because of the following. I want you to see how price is moving through those imbalances on the left side of the curve and how it's referring to those imbalances on the right side of the curve. This is what we mean when we say that the left side of the curve influences the right side of the curve. And this is how we can gauge institutional order flow. So we have come to the end of the order flow lecture. I want to give you some homework. I want you to go into your own charts and study all of the times price reached a POI that you deemed to be relevant and PD rays began to fail to act as resistance or support on price. If you are looking at market maker buy models, your eye should be drawn to the CBs on the left side of the curve to see whether or not they're acting as resistance on price going forward. If you're studying market maker sell models, your eye should be drawn to the BCs that form inside of the left side of the curve and their unwillingness to be utilized as support before being sent higher. You should study at what time or what time interval this reversal period occurs, in which the imbalances begin to fail to act as support or resistance on price and the market begins to show signs of reversing. I want you to collect at least 30 plus charts that have been annotated in depth before watching the next lecture of the model series. The next lecture will be about point of interests. We will create this mechanical rule-based model step by step. I want to thank you for watching this lecture. Be safe and I look forward to welcoming you within the next one soon.